Hello and welcome to ET Inside, where we get you a 360-degree view of the big picture in business and economy. I'm Sridhar Ramakrishnan, and here's what we have for you on the show today. Factory output is falling, the rupee is hitting newer lows, and government's balance sheet may go from bad to worse. Why has the economy hit the brakes, and how bad could things get? Rural markets, that were the big hope for marketers until now, may be losing steam as well. Why has the rural consumer tightened her purse strings, and what is she cutting back on? And Pranab Bardhan, noted economist at the University of California, Berkeley, joins me to spell out why India may be a rising giant, but its feet are of clay. Our top story first. India is showing telltale signs of being in the midst of a vicious economic downturn. Industrial output has contracted for the first time in 2 years. The rupee has depreciated nearly 20% in the last 6 months, and the stock markets have lost 6 lakh crore rupees in value since the beginning of this year. And everyone from rating agencies to even government departments are reworking their forecast for GDP this year and the next. So in a little over a year, we've gone from India shining to India sinking. How bad could things get for you and me? Nikhil Sivadas finds out.
The sun is setting on the horizon, and for the Indian economy, it could be a long, dark night ahead.
Yes, we are in a slowdown. From the point of view of industry, it would be reasonable to argue that we are in industrial recession.
Picture this. Industrial output has now slipped into reverse gear, with the October headline number at a negative 5.1%, the worst in more than 2.5 years. IIP in October last year grew by 11.4%. Mining fell by over 7%. And the capital goods segment dragged the index down, contracting more than 25%, thanks to corporate India putting a halt to expansion projects. The manufacturing sector, which accounts for 75% of the IIP, contracted 6% as export growth slipped and domestic consumption took a hit. The consumer non-durable sector saw a degrowth of 1.3% in October over the same period last year. Consumer durables saw a growth of merely 3%.
Our monthly industrial growth has slowed down sharply for the month of October 2011. This is partly a reflection of the global trends. But our own fight against inflation has also taken a toll on the investments by our corporations.
The warning signs have been coming for a while now. In August, India saw a fourth successive decline in the HSBC Purchasing Managers Index, a headline index which measures the overall health of the manufacturing sector. HSBC's data revealed that the rate of expansion was the weakest in the current 29-month sequence of growth. That was mainly because of 3 reasons: weaker new order growth, which led to a slower rise in production, a sharp contraction in new export business, and a strong increase in input costs and output prices. So this time around, not many were expecting a dramatic recovery. However, the magnitude of the fall is what took everyone by surprise.
I think many people had expected that you would get a negative figure. I think what this indicates is that the turnaround in industry, which we definitely need, had not happened by October. And I think that's not a surprise. It is a matter of concern.
What is a matter of even bigger concern is the fiscal deficit. Finance Minister Pranab Mukherjee has indicated that the government's spending on subsidies could be higher than the budgeted target. The RBI's monthly bulletin released last week states that the combined deficit as a proportion of budget estimates for the first half of this financial year are much higher, notwithstanding the bonanza from the 3G spectrum auctions. That's not all. The RBI bulletin also says that the growth in tax collections has remained far below budget growth, reflecting higher tax refunds and a slowdown in indirect tax revenues.
Our target still remains 4.6%. We want to get there. But we are prepared for the fact that there may be some slippage on that, but we want to keep the slippage to a minimum. Now, let me stress that the fiscal consolidation is a very important part of this government and this ministry.
To make matters worse, the rupee is touching new lows almost every day. The fall in the currency is directly related to India's current account deficit, which is financed by capital inflows. When capital flows slow down, the current account drives the exchange rate and leads to a depreciation in the rupee. For instance, between July 2008 and February 2009, the rupee depreciated by nearly 17%. Similarly, this time around, the rupee has come under pressure because of a wider current account deficit on account of rising imports and slowing export growth. Between April and October this year, India's imports were up 31% compared to the same period last year, and its exports were up 45%. But the surge in exports has not really helped control India's trade deficit, which was up 4,31,268 crore rupees from 3,96,123 crore rupees in the same period last year. According to an IMF report released in April, in dollar terms, India's current account balance in 2011 and 2012 will touch $63 billion and $71 billion respectively, as opposed to $49 billion in 2010. A wider current account balance puts a lot of pressure on the Indian currency, and a weak rupee is bad news for anyone who depends on imported raw materials, because it raises input prices and eventually leads to higher inflation.
The depreciation of the rupee is not going to help, and therefore if the Reserve Bank of India was to cut interest rates, in all probability this is going to cause the rupee to re-depreciate again sharply, and therefore it's not going to do anything on inflation.
But inflation is a deadly monster. It drives up the cost of everything, making money less valuable and triggers a vicious economic cycle if not checked.
Even according to the latest numbers, it is still above 9%. Therefore, the concern regarding inflation cannot be taken away from the monetary authority.
We've taken into account the inflation situation and the moderation in growth. We've given forward guidance about what we intend to do going forward. For the moment, we've decided to stay with the repo rate as it is and have also retained CRR where it is.
That's perhaps why not many in India Inc. are expecting a turnaround in industrial production anytime soon.
For the last 9 times, we have revised sometime once in 2 months, sometime twice in 3 months, the interest rate in the last 24 months, in fact more so in last 18 months. Now, therefore, the project has become so expensive. They have not become viable.
It's clear that the economic cycle has taken a turn for the worse. According to Macquarie, CLSA and Bank of America, the rupee will range between 55 and 58 in the first quarter of the next year, while some like JP Morgan are hopeful that the currency will appreciate from its current levels to touch 48. The larger view is that a fall is inevitable. From currency to the economy. Earlier this week, rating agency Fitch revised its 2011-12 growth projection for the Indian economy from 7.5% to 7% on account of sustained inflation, the global slowdown and high domestic interest rates. The agency says that the Indian economy is likely to regain its 8% growth trajectory only by 2014. If India wants to buck the trend, then it needs to take a serious look at policy making and governance. The recent flip-flop on FDI in retail has made the government's job even tougher because investors are wary of false promises. The question now is whether the government will act immediately or settle for another year of economic lull in anticipation of the next elections.
But waiting for another year may be tough because India is in deep trouble now. Its engine of economic growth, the rural market, is also slowing down. We get you that story from the hinterland after this short break. Stay with us.